But look, I have three main variables, the quality of the business, the quality of the management, and then the price you're being asked to pay. So I just simplify that and say BMP, business management price. So in my framework, business is by far the most important variable because business quality will win out. Peter Lynch wrote his bestsellers 30 years ago, and he said, a quote that'll always stick with me, in the end, superior businesses will win in the marketplace, and their performance will be reflected in the stock market. And mediocre businesses, the same thing will happen. So if you have a good quality business, it's going to grow over time. And that's where the whole concept of a moat comes in, extremely important. And this is an old Buffett concept. What businesses have a good business and have had competitors that have tried to dethrone it and take away some of their profits and have failed? That's the most important question, is the quality of the business. Then the quality of the management, obviously important too. If you have a great business, but an idiot who's running it, they can really destroy a lot of value. And then there's the price. And the price is an interesting variable, Anthony, because basically I learned in my deep dive into tech stocks is one reason they look so expensive and have looked expensive all the way up. I mean, Amazon hasn't earned money for about a third of its life as a public corporation. One reason they look there's two reasons actually that they look so expensive. One is sort of quantitative, which is GAAP accounting. Here in the US, we use GAAP accounting, but also in Europe, European accounting. GAAP accounting was created, was created in the industrial age, when GM and US Steel ruled the economic landscape. And tech companies function in very different ways. For example, when GM builds a steel plant, or an auto plant, I should say, they can depreciate those investments over 20 or 25 years. But when Amazon builds, improves its e-commerce website, it has to expense that spending immediately, 1 year. When Google improves its search algorithm, it expenses that 1 year. So I say in the book, if a tech company has $100 million of R&D spend and $100 million of revenue, they made zero. 100 million minus 100 million. But if an old line industrial company spends $100 million on a factory and they depreciate it over 25 years, their expense is 100 divided by 25 is $4 million. So they made $96 million. So that's one reason why tech companies look so expensive, is because the rules punish them unfairly, in my opinion, for just the nature of their business and how they go about investing money. I think that over time we will see the SEC and the various rulemaking authorities realize this, and they'll change the rules. But as it stands now, the published earnings of tech companies are not what their underlying earnings power is. And then the second reason, Anthony, that the tech companies look so expensive relative to others is they're spending so much more to build out to the future. So to compare Amazon with, say, Wells Fargo, a mature bank, I say in the book, it's like comparing an apple orchard in the springtime to comparing an apple orchard in the fall. Wells Fargo is the orchard in the fall. It's in harvest mode. It doesn't need to grow anymore. You need to pick those apples. So every dollar of income that Wells can bring down to the bottom line is bringing down. Whereas Amazon has, 1% share of worldwide retail commerce, 1%. Everyone says, oh, it's so big, it's so big. It just started selling as much as Walmart did. So there's tons of room for it to grow. So it makes sense for them to reinvest in distribution facilities, in software, and all sorts of initiatives. And this also drags down their earnings. And so, if we really want to compare Wells Fargo's earnings to Amazon's earnings, we need to make adjustments to take into account, one, the accounting differences, and two, the fact that one is in reinvestment mode and the other is in harvest mode.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.